it's important to put a certain things in context for the investors in like this. So I want to spend some time to even explain what does a benchmark even mean to us, right? Obviously, I need to benchmark ourselves for you to explain what we are doing and are we doing a decent enough job of managing your money. But more importantly, you need to understand what does a benchmark even mean as far as the way we manage money. So I'm just breaking down Nifty for you and IT's portfolio for you, right? And let's just go into the constituents. Nifty has 50 stocks. We have roughly around 22 to 23 stocks. The financial exposure in Nifty is 37%. We have it at 10%. The auto exposure in Nifty is 6.5%. That's our heaviest weight today in the form of ancillaries at 18%. The highest weight of Nifty is financials. The highest weight of IT's portfolio is manufacturing. The weight of PSUs is 7.5%. Why did I bring that in? Because in 2022, that was the best performing sector. We had, and we will continue to have zero exposure in PSUs. So what am I trying to explain to you? I want to leave you with three important points. We are active managers and we are not looking at benchmarking or hugging the index as far as constructing portfolios is concerned. What does that mean? Most portfolios, when constructed, many of them start top down. What that means is they say, okay, IT in Nifty is 12%. So when I'm underweight IT, I'll take it to 6%. That's underweight for many. For me, when I'm underweight, I'm zero, right? So for me, it's when I'm underweight, I don't like the business, or rather, I don't like the valuation, which means I'm not looking to hug some index to outperform every year or every quarter or every month. That's not what we do. Because of these kind of deviations, our benchmark and our return will deviate, both positively and negatively. I cannot come and make a statement to you that I will always deviate positively. Life doesn't work that way, right? There will be negative deviations also, and I'll tell you how to think about those negative deviations. How do I measure ourselves internally? I measure it over 3-year horizons. And that is why I always tell any investor who speaks to us on day one, when you give us capital, at least do it for 3 years. And finally, I want to maintain this point that we are not buy and hold investors. We have seen churn, we will continue to see churn, and there is a reason for that churn, and I'll address that later as well. So why do I ask for 3 years? Because that's how we think about fundamentally investing. And now how do I measure ourselves on 3 years, right? So what I'm saying is, the thing about a PMS is a model portfolio is suboptimal for you as investors, because I cannot tell you that valuations are important for me, but I'll run a model portfolio. These are two conflicting statements that you need to understand. So when I tell you that valuations are important for me, it is imperative that I don't run a model portfolio. What does that mean? That different investors coming in at different points of time might see marginally different returns because we are constructing portfolios which are customized for you. So what I need to do is across time, measure how have 3-year returns been for our investors who've started at different points of time. So the chart here shows the line in blue at various start points that the investors may have come in. Why does this end in March 20? Because I'm talking about 3-year returns. So next month when we do this, we'll talk about it from ending April 20 and so on and so forth. On a 3-year rolling basis, we measure ourselves saying, have we done a decent job of outperforming Nifty? And the row in orange, sorry, the line in orange measures the Nifty returns. This is how we are measuring ourselves. And there is a dichotomy because the investors are measuring us on a quarterly or a half yearly or a yearly basis. I am measuring our performance on a 3-year basis. And it's important for me to keep communicating this, right? I know it's not easy, but that's my job. And if I don't do it well, then I'm to be blamed, not you. And I understand that. And that's why we write. The second thing that we also do is we ask for capital calls. Why do we do that? Because I am telling you at that point of time, I see opportunities. Now, sometimes investors acknowledge, sometimes they may not. That's all. That will always be your discretion. But it's important for us to write to you and communicate that. And doing those capital calls, if done at the right time, is an additional source of alpha. I will also aim to return money over time. both partially depending on the opportunity set that we see. So if a certain pool of capital has generated the return that I expect, and I don't find adequate opportunities, I might choose to return capital.